So, bro, what's up?
Well, Allison, a few episodes ago, we highlighted how this has been an extraordinarily good year to be an investor in U.S. stocks. From January to April, the S&P 500 returned over 18%. It was the best 4-month start to the year since 1987. And then came May. So as of this taping, May 30th, the S&P 500 is down 5.5% this month. So when stocks do well for the year, but then they start to slide in that 5th month, we often hear one of the most well-worn adages in Wall Street, which is...
Sell in May and stay away?
There you go. You picked that one out. Excellent. So the basic premise is that the stock market does not do quite as well from May to October. And it turns out there's actually some proof of this. So here's some numbers from LPL Financial that looked at 6-month returns from 1950 to 2018. So, from January, the first 6 months, and then the next 6 months, and so on. So on average, over a 6-month period, the S&P 500 returns 4.3%. The best period, November to April, average return is 7%. Worst, May to October, 1.5%. But they also looked at the percentage of times that the market actually makes money over that period. On average, over a 6-month period, the market makes money 69% of the time. Best, again, is November to April, makes money 76.8% of the time. Worst, April to September, but just slightly behind it, is May to October. So there is some evidence that May to October is not quite so good. But historically, you are still likely to make money, even if it's not as much. So, of course, I'm not going to tell you that you should cash out your stocks and wait around until Halloween to get back in the market. But I will think it might be worth considering to do a little tweaking to your portfolio. So maybe we should change it to rebalance in May and stay away. Why would you do that? Well, if you haven't rebalanced your portfolio, especially over the last decade, it has become much more risky. So just as an example, let's say a decade ago, you were 75% stocks, 25% bonds. Over this decade, it has grown to where you are now 88% stocks, but you've also gotten 10 years closer to retirement if you are not yet retired, or you've just gotten older, when generally speaking, you should be getting more conservative. So rebalancing really isn't necessarily about getting better returns. It's about being in control of the risk characteristics of your portfolio. And that is the bottom line of a recent report from Vanguard, which came out in rebalancing, looked at a few things. First of all, looked at the returns of a non-rebalanced portfolio versus a rebalanced portfolio. And there's no question, especially when you're rebalancing between stocks and bonds and cash, rebalancing lowers your returns. On average, you're going to earn higher returns if you stay all invested and just let stocks overwhelm your portfolio. But you widen the possible results. So if you never rebalance, you could have extraordinary returns, but there's also a chance that you will have not so good returns. Whereas if you rebalance your portfolio on a regular basis, you narrow the range of your returns. You won't have exceptional returns, but you won't have horrible returns. So the next question is, how often should you rebalance? Well, Vanguard's report looked at that too. There are really two ways to do it, either by time, like annually, quarterly, monthly, or by threshold, meaning once your allocation has gotten out of whack by a certain amount, you bring it back in. So let's say, for example, you decide you should have 75% in stocks. You would rebalance once it grows to 85% or down to 65%. What's best? Interestingly, it almost doesn't matter. The returns are almost identical, as well as the risk profile, whether you look at volatility or something known as the Sharpe ratio. What's most important is that you're doing some sort of rebalancing once in a while. I think every few years is probably good enough. I'm going to close here with a few tips about actually how you should do the rebalancing, sort of the nuts and bolts of it. First of all, if whatever possible, do it within an IRA or a 401k or a tax advantage account, so you don't have to worry about paying capital gains taxes on that. You can rebalance with cash flow. So if you are still saving for retirement, you can devote your contributions to your 401ks and IRAs to the stuff that's underweighted. If you're retired, you can rebalance by taking money out of the investments that have done particularly well. If you're charitably inclined, you can rebalance by donating appreciated stock. When you donate appreciated stock to a qualified charity, you avoid paying the capital gains and you might get a tax deduction. Or if you're 70 and a half, you can rebalance by making what's known as a qualified charitable distribution from your traditional IRA. You don't have to pay taxes on the distribution that way. Also, it counts as your required minimum distribution. If either of those things sound good to you, make sure you learn more and maybe talk to your tax broker, because there are some rules you have to follow. You can also gradually rebalance your portfolio by not automatically reinvesting the dividends into the stocks that paid them. And it could be bonds too as well, or any of your mutual funds. And instead, either let that accumulate in cash and then put it towards underweight investments. Or if you're within like a decade of retirement, it actually makes sense to just let that accumulate in cash and bonds, because as you get closer to retirement, that'll naturally make your portfolio more conservative. And finally, consider the quality as well as the quantity of all your investments. When you rebalance, it's a good opportunity to just look at everything you own. Do that thought exercise. If you look at an investment and say, if I didn't own this, would I rebuy it today? If you've actively managed mutual funds, we've all heard that most of them are not beating index funds. So this is a good opportunity maybe to get rid of some of your underperforming funds. Is management still doing the job you want to do? All those things. It's a good time to reevaluate portfolio. And for any investments that you no longer believe in, you can rebalance just by getting rid of them. So the bottom line on this is basically rebalancing is a risk management strategy, not a return enhancing strategy. If you are very aggressive, if you're more than a decade from your financial goal, it may not be actually all that important. But if you are conservative or moderate, or if you're getting within a decade of your financial goal, buying a house, going to college, going to retirement, managing your risk is much more important, and rebalancing is one way to do that. And that, Allison, is what's up.